Hey everyone, and welcome back to the channel where we demystify the markets and break down complex concepts like short squeezes and hard to borrow stocks. Today, we're diving deep into a fascinating microcap name that's recently landed on our screen due to some extreme hard to borrow characteristics. Lions Oil International Group Limited, trading under the ticker LHSW. This isn't just about the generic hard to borrow stock. We're going to use LHSW's very specific numbers to illustrate exactly what we look for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Lions Oil International Group Limited, or LHSW, operates in the technology and software infrastructure sector in China. Through its subsidiaries, LHSW provides machine vision products and solutions, including industrial machine vision, artificial intelligence products like face recognition and AI behavior analysis, and intelligent weak current products. It's a very specialized area. Currently, LHSW is a microcap with a market capitalization of just $9.08 million. Looking at recent price action, LHSW has seen some significant volatility. Today alone, the stock is down -12.46%. Over the last 5 trading days, it's fallen -24.31%, although if we zoom out to the last 30 days, LHSW is actually up +20.22%. This kind of wild swing is not uncommon in small cap names, especially those with unique characteristics like LHSW. Volume-wise, today's trading has been very low at just 74,507 shares, a stark contrast to its 30-day average volume of over 4 million shares. That gives LHSW a relative volume of 0x its average, indicating very little trading activity today compared to usual. What is cost to borrow and why it matters? Before we get into LHSW's specific hard to borrow numbers, let's quickly explain what cost to borrow, or CTB, is. When you want to short a stock, you first have to borrow shares from someone who owns them. The fee you pay for this borrowing is called the cost to borrow. It's essentially a rental fee, usually expressed as an annualized percentage. The higher this fee, the more expensive it is to short the stock, and it generally signals high demand from short sellers or a very limited supply of shares available to borrow. Why can it exceed 100%? Imagine renting a rare item if demand is sky high and supply is almost non-existent. The daily rental fee can become astronomical, quickly exceeding the item's value over a year. It's the same principle for these borrow fees. Why the stock is hard to borrow right now. Now, let's talk about why Lions Oil International, LHSW, is standing out on our hard to borrow screener right now. This stock has an astonishing cost to borrow fee of 710.5% annualized. Yes, you heard that right, over 700%. Highlight CTB. This is an incredibly high fee, signaling extreme pressure in the borrow market for LHSW. Even more compelling is the CTB momentum. It surged by +503 percentage points over the last 5 trading days. This rapid increase shows that the cost to short LHSW is escalating dramatically. Furthermore, the supply side is incredibly tight. There are only 10,000 shares currently available to borrow. Highlight available shares. When you consider LHSW's estimated float is a tiny 0.1 million shares for 100,000 shares, the 10,000 borrowable shares represents a significant portion of the total available. Our internal composite squeeze score for LHSW, which combines factors like CTB, borrow supply, float size, and price momentum, currently sits at a notable 60.8 out of 100. All these numbers collectively scream hard to borrow for LHSW. Squeeze mechanics explained. So, what does it mean when a stock like LHSW is hard to borrow with such high fees? It sets the stage for what we call a short squeeze. Imagine this scenario: short sellers have borrowed shares of LHSW, betting its price will fall. But now, the cost to hold their short positions has skyrocketed to over 700% annually. If the stock price starts to rise, or if short sellers simply can't afford the exorbitant fees anymore, they are forced to buy back shares to close their positions. With only 10,000 shares available to borrow and a tiny float of 0.1 million, any significant buying pressure from short covering can quickly overwhelm the limited supply of shares. This creates a feedback loop. Buying pushes the price up, which forces more short sellers to cover, driving the price even higher, causing more covering, and so on. That's the essence of a short squeeze. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have very strong conviction that the stock price will eventually fall further, and they are willing to pay those high fees to stay short. Dilution risk check. One of the most significant risks to any short squeeze thesis is dilution. Dilution occurs when a company issues new shares, increasing the total supply in the market. This can offset or completely negate any upward price pressure from short covering. We always check for this. For LHSW, we found no recent diluted SEC filings such as SMINUS1, SMINUS3, or 424B in the last 90 days. So, at least for now, there are no immediate red flags concerning new share issuance that could undermine a potential squeeze scenario. Recent reverse split watch. Another important factor for LHSW specifically is its recent reverse stock split. Lions Oil International executed a 1-for-16 reverse split on June 22, 2026, which was just 21 days ago. A reverse split reduces the number of outstanding shares and, consequently, reduces the float, while resetting the share price higher. For example, if you owned 16 shares at $1 each after a 1-for-16 reverse split, you'd own one share worth $16. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market digests the new share structure and higher price point. This is a pattern we've observed in some names, not a guarantee for LHSW, but it adds another layer to watch with this stock. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given everything we've discussed about LHSW, what should you be watching for? First, keep an eye on the cost to borrow. Is it continuing to climb, or is it stabilizing? Second, monitor the shares available to borrow. If that number drops even further from the current 10,000, it intensifies the squeeze potential. Third, volume is key. Despite the hard-to-borrow status, today's volume for LHSW is extremely low compared to its average. For a squeeze to materialize, you typically want to see a significant surge in buying volume. Without that volume, the stock can simply continue to drift or decline, as it has in the last 5 days, despite the underlying borrower pressure. Watch for any signs of a reversal in price action coupled with increased, sustained buying volume. Lions Oil International, LHSW, presents a compelling case study in a hard-to-borrow stock due to its exceptionally high cost to borrow, rapidly increasing fees, and extremely limited borrowable shares, all against a tiny estimated float. Add in the recent reverse split, and it's certainly a stock with unique dynamics. While these conditions create the potential for a short squeeze, remember that potential doesn't equal guarantee. Always conduct thorough due diligence and understand the risks involved with highly volatile microcap stocks like LHSW. If you found this deep dive into LHSW helpful, please hit that like button, subscribe to the channel for more educational content, and let us know in the comments what other stocks or financial topics you'd like us to cover next. Thanks for watching, and we'll see you in the next video.